Rupert, when you look first at the protests in Hong Kong that they're planning, this law and the tensions in general between the U.S. and China, how much more angst will it put on markets that are already really fragile?
Yeah, I think, look, obviously it's difficult for markets to try and price sort of increasing geopolitical risk at the same time as trying to deal with this unprecedented COVID economic and social crisis. But I think this is a specific example of the fact that markets are still underappreciating the likely scope and extent of U.S. China tensions. So I think we shouldn't be calling this a trade war anymore. We should be calling this kind of full spectrum strategic competition. I think we are inevitably going to get some kind of U.S. response to these Chinese actions, and I think that is still not priced, particularly in assets that should be sensitive to this, so Asian FX and credit, maybe even Chinese ADRs, Taiwan. I think that there's a lot further to go in the escalation of these U.S.-China tensions.
I mean, do you care or do you not care as long as the Fed is there?
No, I think this is an important kind of long-term contributor of risk. I mean, we are pretty cautious from here, actually, overall on risk generally. I think that yes, the Fed has provided enormous support to markets, and that's very, very important to bear that in mind. And indeed, would have been entirely wrong-footed over the last month or so if you had not taken that into account. But from these levels, we think that both on the COVID and macro front, and also on this geopolitical front, I think that markets now look a little bit complacent.